Newsflash, all right? And this is from the risk manager perspective. Risk reward is linear. Whether you have a 10 to 1 or a 1 to 10, the math basically says that it doesn't really matter. Now, there's a couple of little variances I'll talk about in a second, but we're all talking about that 2 to 1. You must have a 2 to 1. You must have a 3 to 1. Cannot be farther from the truth. Hey guys, welcome back to the channel. Well, I got an interesting request from the boys at Desire to Trade to basically do a video on, hey Mike, tell us a little bit about behind the scenes of risk management and really what risk managers, whether on the prop side or individual traders, what are they really looking for? And kind of give an inside scoop on some of the things that we may not know about. So you want to tell all, huh? Well, let's get to it. Okay, so I've been doing this for some time now. Risk management, early 2000s, certified since 2007. So I'm not going to bite the hand that feeds me, but yeah, sure. I'll give you a little taste of what goes on behind the scenes and really what the risk management community, whether it's coaching, prop firm risk managers, or even hedge funds, what they're really looking for. And really, the takeaway is not about, well, I don't work for a hedge fund. I don't need this information. Well, hold on a second. You'll benefit from it. I made sure I tailored it. So even the individual trader trading at home can add some value to it. So let's get to the first one. Prop firms. Prop firms are more interested, at least on the risk management side, of protecting the firm's capital than your success. Now, hold on. Let me be very clear about this. They want you to succeed. All right. Most legitimate firms, and definitely the brick and mortars, want you to succeed. Actually, the human resource element, or even recruiting for traders, or even trader challenges, they're actually quite costly from a resource standpoint, whether it's time, effort, and even dollars. They want to really make that money back, and the way to do it is for a trader to stick on long enough and actually be successful and play a role in generating profits for them as well as the firm. So they want you to succeed, and again, all the legitimate ones. But at the end of the day, the risk manager is constantly keeping an eye on the portfolio, right? If there's a trader that goes rogue within their risk controls and it just doesn't work out for them, the key thing is that the portfolio is intact. They're going to have traders that make it, and they're going to have traders who are not. There's sort of a inherent anticipated percentage of all that, and that's put into the business model. But at the end of the day, the risk manager is really looking at the portfolio. Their job is to protect the company's assets or the investor's assets. Bottom line. And if a trader doesn't make it, and a few traders do, so be it. Those assets of the company are the number one priority for the risk manager. So while the risk manager may encourage you, train you, coach you, whatever it is, provide you with the materials and tools it is to be successful. At the end of the day, that responsibility is yours as the trader, and the portfolio, the assets, are the number one thing that they're concerned about. Okay, number two. Now you would think the risk management or risk management department of a prop firm or someone overseeing managed capital would think, okay, we really want the trader to eventually have, consistent profits. Well, of course. But really, at the end of the day, they want to be sure they're able to follow a process, not necessarily focused on profits, especially in the beginning. Sure, after a while, you should be generating consistency and things like that. But they're really, from a risk manager perspective, the most important thing is to see a trader follow the rules of their plan, but also follow the rules of the firm. And if they don't make money in the beginning so much, but they have those sort of seeds of encouragement and the seeds of, hey, this could be potentially a really good trader, they just need to work through it. Maybe there's training and development and areas of skills that they've already identified or the firm's identified, or even more importantly, the risk manager has identified. They're okay with that. Even if they're sort of losing money in the beginning, they're investing in a person that has that potential, as opposed to the person who goes in there and thinks they're Superman and starts cranking out these profits like out of crazy for the first few weeks. The flag on the risk manager's head really goes up and say, we got to stop this, even though they're doing really well and the firm's making money from them. So really, contrary to what most people think, they want to see traders consistently making profits, especially in the beginning. They really want to see them and have the trader's ability to basically be able to follow a plan. And even if the profits aren't there. I've talked to other risk managers and I've talked to prop firms, and they said, yeah, we're really not that concerned in the beginning if they're making money, as long as they're hanging in there, we'll provide them the training and the skill sets and the coaching to get them where they want to go. But they have to have that core skill sets, and so be it. But you would think that they just want to see profits every week, but not necessarily the case. Okay, and I know a lot of traders look at their risk reward, whether it's on a trade basis, a weekly basis. What's your average, risk reward? I get that question all the time. Hey, Mike, what's your risk reward? Newsflash, all right, and this is from the risk manager perspective. Risk reward is linear. Whether you have a 10 to 1 or a 1 to 10, the math basically says that it doesn't really matter. Now, there's a couple of little variances I'll talk about in a second, but we're all talking about that 2 to 1. You must have a 2 to 1. You must have a 3 to 1. Cannot be farther from the truth. I have worked with traders who have an 80%, 90% success rate on winning trades, but their risk reward is like 1 to 2. All right. And you'll have someone with a 20% risk reward or success rate, and their risk reward is say 4 to 5 to 1. They'll take those small losses and let them run runs. Both are successful houses in the Hamptons, so that kind of stuff. It really doesn't matter. It's contrary to what you hear a lot about. Like, you got to have at least a 1 to 1. Further from the truth. And when you talk about certain products like options, I mean, you could have 10 or 20 to 1 risk reward. Take those small losses. Now, there's a psychological element that the risk manager would want to kind of oversee. Like, how many losing trades in a row can you have without sort of losing confidence and things like that? But again, the best traders, doesn't matter. I've seen them all over the map. So remember that risk reward is linear. And if someone tells you that you need to have a 2 to 1 or 3 to 1, start to question who that person is. And if it's your coach, maybe think about getting a different coach. I know this is something that's sort of unique in the space, and I've preached this before, and I don't see too many on other YouTube channels talk about this, but understand that risk reward is really just a math equation, and it really, almost in a sense, doesn't matter. Now, I highly suggest you consider having stop placement beyond the randomness area. So if price is chopping a certain area, have your stop where you're wrong. But I've seen traders have it where I don't care if it's in the middle of randomness, I'm going to put it really tight. And I don't mind having like a 15% success rate because I'm able to handle that psychologically and do that. I've seen successful traders do pretty much anything, as long as they understand the principles of risk reward and adhere to their plan and do it consistently. Okay, now this is sort of on the risk management corporate side, but even on the coaching level, I experienced this too. Is the risk manager pretty much is always worried about something. I mean, there's never one thing that say, oh, everything's looking good. I mean, funds are reaching high water marks. We have people passing challenges and everything's great. We're always worried about something. What's that next shoe to drop? What's the black swan? All right. If a trader goes rogue or something and they didn't put the risk controls in place, trying to help them. But at some point, you have to say, look, if you don't have a plan, you're not following your rules. We kind of have to sort of let them learn, the hard way, which is something we really don't want to do. But we're always concerned about something, particularly and recently in these markets, a black swan event where you have a big downdraft after like several weeks of just up moves, and you get very comfortable about taking longs, and then people just get, a lot of traders get wiped out. So the question is, how do you handle it? How does a risk manager oversee that, and does the coaching change a little bit? Well, we're always sort of worried, particularly in high bull markets like the Nvidia run and things like that. Say, when is the shoe going to drop? So we're always concerned about that. We're also much more involved in other parts of the business, like in the marketing of prop firms, or maybe it's in the portfolio level, maybe regulatory. Maybe there's a big investor who wants to put money into the fund and fund, say, newer traders looking to win prop challenges. The risk manager is always involved in those meetings. You're always concerned, particularly in areas where maybe an investor is disappointed in the return, or maybe a downdraft or a drawdown at the portfolio level. Rather than have just someone, even the owner of the firm, talk to them, they'll tap the risk manager. Hey, can you take them out to lunch and just talk to them about what's going on and how we're dealing with it and dealing with such. So it's not necessarily about making sure traders put stops in place and things like that. There's a lot more to the risk management side. And then from a trader's perspective, think of yourself as your own hedge fund. So start to think like that. Where am I doing? How am I doing in particular trades or different markets? Or how do I grow my business by raising more capital? Maybe it's outside of the prop firm space, which is always very crowded and sort of challenging these days. right? Maybe if I can start with friends and family or something. So start to think more of like a corporate risk manager as opposed to just placing stops. Okay, number 5, the topic of risk of ruin. Risk of ruin simply is defined as, what happens if you blow up? Like, what is it going to take as far as losing trades, sizing, things like that, to where you're just blown up? Well, from a risk management perspective, risk of ruin is sort of defined differently with different traders. Some may look at it and say, okay, I'm going to put $10,000 of capital, I'm going to trade that. Well, if they blow, say that $10,000 or just goes to zero, they're done. Like their career's over, at least for now, and that's considered 100% risk of ruin. But say someone puts the same 10,000, but they have a home, they have other assets, they have retirement money, and really that 10,000 is really just, say, 1 to 2% of their entire capital, and their family supports them, their spouse is like, yeah, sure, 1-2%, you want to go for it and give it a shot, that's fine. Well, if they blow that, is that risk of ruin? Well, it may be on that particular account, but as far as their lifestyle, whatever, they may just like take a deep breath, maybe get some more training, and maybe give it another shot. So when we look at risk of ruin, one of the things from the risk management side we're looking at is, what are we looking at here in regards to really what's your true risk of ruin? And really, the key word there is ruin. Ruin is done. Like, that's it. No more trading. I mean, move on to another profession. And most of the time that I found out is really the risk of ruin, they define it as blowing their account, but really you really should look at risk of ruin is, what's going to take for your quote trading career to end, and because that's ultimately what we really don't want. So one of the suggestions is if you have some capital, segment them into 3 or 4 phases, and really do not go digging into that second pile until you really have learned the lessons from the first one. So we're trying to prevent risk of ruin from game over, as opposed to just blowing a small account. All right, so let me throw in a bonus one for Etienne and the boys. The bottom line is, all the stuff I just talked about is BS if you don't have a plan. What's the famous quote by Mike Tyson? Everyone has a plan until they're punched in the face. Well, I see a lot of traders who have all this stuff down and everything, but what's their plan? So let me see their plan. Or can you look at my trades and do a review to see if I'm doing okay or anything wrong? Well, how do I know if I don't compare it to a trading plan? So a lot of the stuff that we talked about, it's all crap, right? We need a plan to execute, preferably one that has historical edge, and then we can modify that. But really, most of the traders I see have struggled or failed or hit that risk of ruin that we just talked about. It's really because they didn't have a plan to start with. So take a step back. Step 1, get a plan. It doesn't have to be perfect. I've been doing this 24 years. I'm changing mine constantly. All right. Just get something to go on to where you're going to have and follow a plan that has risk management, discipline, and maybe a couple of the strategies that you're going to start with that you're able to follow your rules. And obviously you'll monitor that through your journal. So key thing on the risk management side, it's all crap if you don't have a plan. So let's get started today if you don't have one. Okay, so I hope you got something a little out of this quick, brief assessment on what really goes on behind the scenes of the risk management process and really the role of the risk manager. But I'll even go further. Click on the link below, and I'll give you some strict principles that you can specifically, as a retail trader, use in your risk management portion of your trading plan. I'll make it simple, easy. A lot of it's copy and paste, and you can just modify as you need. All right, click on the link below to get that, and also subscribe if you haven't done so already, and click the like button. It also helps the channel out as well. All right, good luck, and we'll see you next time.